Hello everyone, and welcome back to our Hypernest podcast. During this pod, we interview incredible DeFi builders and Web3 leaders, and we talk about everything related to DeFi, of course, is our main area of interest, and in addition to that, of course, several other topics that are really related to entrepreneur in the Web3 space. So today I have the incredible pleasure to have with us Colin, that is the head of product of Liquity V2. And we are super excited because, well, Liquity V2 just launched. We have already 46 million, I think, in TVL. I checked a few minutes ago. Well, first of all, Colin, congratulations for the great launch. And other than that, please tell us something about you and how you are involved in Liquity and Liquity V2.
Great, thank you very much, and thank you very much for having me on today. So, as you said, we're very excited with the launch that we launched. It was a week ago tomorrow. So it's still a very young protocol, as you said. $46 million as we're speaking here on Wednesday, the 29th of January. 46 million TVL, approximately 17.5 million bold minted. So very excited about that. As you mentioned, I'm the head of product, so I was responsible for a lot of the coordination. I can't take all the credit for the fantastic job that our business teams have done, our tech teams have done. It's a huge team effort. There's 11 of us on the team who've been working at this for quite a bit of time with the stuff that we've learned before I joined. So just want to give a shout out to everyone else on the team. I get to be here today though, and you get to listen to me. So. My background, obviously, I'm leading product at Liquity, as you mentioned. I started out my career working in finance on a trading floor for a French bank, originally in Paris and London with a short stint in New York. I love weird financial products. I got into crypto in 2014 and set up kind of their first team as part of the trading arm of the bank doing research. And the first question was, hey, is this Bitcoin thing worth anything and should we do anything with it? Believe it or not, my answer was yes. The bank still has not done much because it is a large French bank and they're not known to move quick. So I set out on my entrepreneurial career in early 2016, working full-time in crypto. Been doing this for a little while now. Originally kind of focused on things that we call DeFi with derivatives, more for large enterprises back then. Really kind of DeFi took off much later. I did some back and forth ping pong with DeFi and NFTs and kind of said about 2 years ago, I really want to get back into DeFi. There's big opportunities. We've done lots of advancements and joined the guys at Liquity and have been enjoying every day since. So a lot of work, a lot of hard thinking that goes in and I'm really proud with what we've been able to deliver.
Thanks for the super interesting and super exciting, intro. So I think that we can start with a little bit of this transition from Liquity V1, so with LUSD, that was also a very, very beloved protocol in the DeFi space. But how did we move? So when, let's say, how the thinking process started for this enormous transition?
Yeah, so no, that's a great question. So the thinking process started a long time ago. So we are very happy with what we were able to deliver with LUSD and Liquity V1 back in 21. And people seem to like it. There's two things that we keep hearing when we talk to people about V1. They really like that it's immutable, that there's no governance, that we can't do anything to it. It is written in stone. So it's very close to the ethos that a lot of early DeFi was in, and personally kind of where I would classify myself. The second thing that people really liked about V1, which ultimately kind of put a bit of a break on V1, is interest-free borrowing. So the idea with V1 is I could put in Ether, and I could borrow LUSD, the V1 stablecoin, by just paying 0.5% interest one time. Seems too good to be true. The markets found out and obviously put a bit of a break on that. And the way that we manage how much debt is out there to make sure that our token's always worth about $1 is that we have a mechanism called redemption. In short, what this means is we take all the borrowers, we call them troves. You might know them as collateralized dispositions or vaults from something like Maker. The similar concept, we call them troves at Liquity. We line them all up by which one's the riskiest, which one has the most debt per collateral, You can think of this as LTV, or we call it collateralization ratio, and we line them all up. And when the token falls below $1, anybody can permissionlessly come back to the protocol, and it can return the LUSD, and it can take out that underlying Ether collateral against the riskiest, i.e. the highest LTV or lowest collateralization ratio. It worked. The token, the stable coin is worth about $1, but we dropped from multiple billion in LUSD issued. Over the lifetime, 5 billion have been issued. At the max, I think we had 1.5 billion in max supply of LUSD, so quite a big number. And we've dropped down to currently about 60 million. A lot of this is because of users paying back, and a lot of it is because of redemptions. This became a big problem for users, and so we said, well, is there some way that we can keep that first ethos and fix this? And after many iterations and thoughts about how do we build a better liquidity product, we stumbled upon this idea, which is, what if instead we take away that kind of free borrowing, which everybody loves, and we give users a choice that maintains our immutability, and that choice is how much they pay to borrow. Now, this is kind of our USP inside of it. Aside from being immutable, from being governance and external dependency reduced, we allow users to decide how much they're going to pay. And very much with V1, this puts them in a list. If a redemption order comes in, we've maintained that. And we say whoever is the lowest paying will be redeemed. So bold our stable coin on V2, trades below peg. We go back to the person that's paying the least, and we say, thank you very much. We'll take your collateral. Your debt's now gone for an equivalent amount. Obviously, that's not a pleasant thing, especially if you want to keep upside on Ether, or you're worried about the taxation of this. So that unpleasantness kind of maintains that people are not always paying the lowest rate, but they're paying a fair market rate. And our hope with this is this fair market rate that's developed by all users of our protocol in a permissionless, immutable way becomes a reference that other protocols can build in to build much more complicated things on top, like derivatives markets, or if we're very lucky, it can be used to instruct something that looks like a benchmark rate for all of DeFi, or at least within the Ethereum ecosystem.
Fantastic. We already started to enter, in the core, right? And I love that. Yes, I would say that probably one of the most innovative and interesting part of Liquity V2 is the possibility to set your interest rate. And I think that we need to dig a little bit deeper into it, right? So I think one of the great innovation is that you set your interest rate. This interest rate doesn't fluctuate, right? Of course, you might decide to change it. As I've been reading in all your docs, I really enjoyed it, but it doesn't fluctuate, meaning that your DeFi strategy theoretically are safe enough if there are no redemption, right? I think it will remain still safe, right? You just lose. Part of your collateral will be just redeemed, right?
Yes. Yeah. So, yeah, I think you exactly pointed it out. I mean, there is a risk, obviously, that you could lose your collateral. You don't lose things. This is different from a liquidation. They are cousins, but it's not a liquidation. You could lose that collateral and your debt is repaid. At the time of that happening, you are exactly equal. You don't have more dollars or less dollars because it swaps it at the current rate. But obviously, for reasons that we mentioned, that's unpleasant. And the big benefit for you as a borrower is you should have more certainty than you would inside of a market borrowing and lending protocol like an Aave, where those rates can fluctuate quite a bit.
Yeah, absolutely. And how do you think, I've already studied also the interface. By the way, I also love the idea that you have more front end, very aligned with your ethos from the beginning. How do you think the user can decide their interest rate?
Yeah, so that's a great question. I think the nice thing is there isn't one answer to that. So each user kind of has their own view in mind of what they're going to do with borrowing, how long they want to borrow for, what they're going to do with the money that they borrowed. Will it be instantly accessible, or do I need to put it away in something that might be a liquid? One of the big use cases that we're looking at is we kind of see most borrowing inside of DeFi today is very short-term, very liquid backing, meaning I go borrow money from Aave, I use that to swap into some trading position, and I can always undo that instantly, atomically, or within a couple of hours or a couple of days maximum. There is a big chunk of people that say, hey, I want to be able to borrow, but I need this money for 3 to 6 months, 12 months, and I can't move it. And obviously one of the really big use cases there is I want to go invest into, they're coming back now, these private rounds, something like Echo or the other competitors, where I know my money's going to be locked away to invest into something else for a longer time. And that's kind of where this question would kind of come in, and we'll talk a bit more about use cases here. But a user that's worried about a longer term thing might say, I'm willing to pay a little bit higher rate because I need this money I want my collateral to always be there. I don't want to take a tax hit, and I can't go repay this thing back. So the best way to do that is to set a rate that's kind of around the average or at least further away from it. There are some people that say, hey, I'm going to monitor this thing constantly. I'm willing to go through and move it when I'm worried about the rates, and I have liquid bold to be able to go back and do that. And that's for arbitrage trades or more classic leverage or things like that. And those users probably say, I'm coming to you because I want the lowest possible rate I can get. And they're willing to sit a bit closer to the edge. Across this, we arrive at kind of what's this average rate. So I would say it really comes back to your personal situation, what you're intending to do with the money, how active you plan to be on the platform. Personally, I'm a bit more conservative. I would use the platform, about in the middle.
I see. I'm completely with you. I mean, I don't want to monitor too much, but I also discovered that it's possible to delegate a little bit this type of system, because it's always possible to change your interest rate, as far as I understood, but you just pay a little. Let's call it penalty if you do it too often. Let's say I think the time horizon is 7 days, right?
Yes. Yeah. So we have a feature in there, and the reason this feature exists is to keep people from setting the lowest rate, waiting for a risk to happen, moving away from it, essentially front running that, and then sandwiching the rate back down. And so a design decision was made in there to say users can change their rates whenever they want. They could do this within 2 blocks if they want. But you'll pay, if you've changed your rate more often than every 7 days, you'll pay a supplementary fee equivalent to the average rate for 1 week, which makes that a particular concern go away. So it also slows down the rates. It makes users think about how certain am I that I don't need to move this rate for 1 week most of the time. If they move it on a weekly basis, that's fine. Up, down, whatever they want to do. And hopefully that will just kind of slow down that process. As you pointed out, I can rely on somebody else to do this. We have a feature called delegation. And this means that anybody permissionlessly can come in and register themselves and say, hey, you pay me a fee. Here's the fee. I'll set that. That's immutable. And I'll manage your rate for you. Obviously, you're trusting them to make sure you don't get redeemed. But they can't take your collateral out. The biggest risk is they could just not update your rate, or they can make you pay too much. So it's not something to do just willy-nilly. You should trust those people. It's a relationship between them. We have a couple of different things that are coming out. One of them to be announced soon that will rely on an immutable protocol to help do that. And we also have one of our front ends, as you mentioned, we don't run our own front ends. One of our front ends is run by a team that manages Liquity.app called Summerstone, and they manage this. And then there's another team that's put something together, who is a researcher who's been in Liquity community for a long time. And we also have a lot of others that we've been discussing. This is a really popular thing that people are coming into, especially what's really interesting is to see some very, very large names in crypto come in, because they say, we understand more about borrowing and DeFi than probably anybody else. We know how to manage this kind of system. If lots of users come into us, obviously we make money out of managing all this money, but we also have that insight into the market to be able to kind of move other rates around and arbitrage between what happens in a place like Aave or Maker or Athena against what they're able to deliver here. So lots of really exciting things. This is a part of the product that we're just kind of scratching the surface of. And we plan to do another kind of big push and bring more players into that in a few months.
Very exciting, super cool. I think the one that there is now there, it's like charging 0.3%. Mm-hmm. So it's basically very reasonable also to keep an eye on your interest rate, right?
You do, yeah. They do charge you for that, and hopefully they're able to manage it in a way that does save you at least that. And we do expect to see more that should offer different rates. The important thing to know about those rates is they can't raise those rates on you, or they can't lower them either. They have to issue a new strategy that they would go through, and they would maintain and update that. So that should give users a peace of mind about what the manager is able to do. But that's a feature that we're very excited about, and you'll be hearing a lot more from us in a few months on that.
Absolutely. All right. The question I have. Meanwhile, I was studying all your documents, and I'm sure that you have put a lot more thoughts than me on that. So, what if Bolt doesn't depeg or it doesn't trade below $1? Basically, people will be, I think, incentivized to kind of set lower interest rates because most of the time there is no redemption. I'm sure that you have put a lot of thoughts on it. What's your take?
Yeah, I mean, I think if we're able to maintain a situation where there is a ton of appetite for Bold at or above $1 value, there's a few reasons why that could happen. The most obvious is, people want to sell their crypto and they want to buy a safe haven asset. Ours is V1 was considered a safe haven asset. So people would naturally want to buy Bold, even if they're not earning any money. So we saw this during COVID and during the financial crisis in 2008. People just wanted dollars at any cost. They didn't care about how much interest they were earning. In crypto, 2 years ago, we were kind of in a similar situation where people said 1% yield is great. If I can get 1%, I'm happy. It could be that you're able to borrow for very, very cheaply with us, and we're able to deliver a rate that is at or above market. Something that's really important to understand about us, compared to a lot of the other protocols, we are straight pass through. Every dollar that is created through borrowing is passed directly out the door, either to our stability pools, where you come into our protocol to earn, or to what we call protocol incentivized liquidity, PIL. And that is managed by a small governance system that is very constrained. And every single week that collects money, and tonight is actually the first night we'll see that in operation, and passes it out currently to Curve and the DeFi collective, which will manage kind of L2 liquidity. So all that money is passed back out. And if you compare this with something like Aave, and throwing no shade on Aave, they're just very big. And a lot of people are familiar with them. I think it's a great product that I personally use. When I borrow, it might cost me 10% to borrow USDC. If I deposit USDC, I might earn something like 4%, maybe. There's a pretty big spread there, and if I want to just take one side in and put it on the other, it's not great. Because we pass everything and we mint Bold on demand, our rates that it costs to borrow should A, be lower, and B, should be much more similar, sometimes even, which is our current situation, below what you can earn from placing in the stability pool or into an LP position on Curve. Because we have that straight pass through, we literally take zero margin out of it. Outside of additional incentives, printing new tokens, new money, you cannot get better than 100%. It's impossible. So our hope is, by being an option out there that in time people will hopefully trust, we're able to deliver a very good outcome for users that is very, very efficient. That's where we want to be. It is very similar to a public good. It's not a public good. I don't want to say it is, because the public goods people will come in and point out where the differences are. But economically, it passes as much, which is everything, through from one side to the other. And we think that's very important for users. And we think hopefully in a situation where people are able to borrow maybe even at 1%, we might be able to pay people 1% to hold our stablecoin in the stability pool. And that would be a very good outcome for users, especially if they're facing a 0.5% situation.
Yeah, absolutely. Well, thanks a lot for that. And I think that we should also remind another thing in general about Bold, that it's very exciting for me. There are no third-party dependency as a stable coin, right? So we are not relying on money that are in another pool in another place,
There's one caveat there. We do rely on an external dependency, which is Chainlink oracles. So we've worked with Chainlink in V1. It is our one kind of outside dependency. Everything else is compartmentalized and then hooked up outside. But yes, we are as close as to no external dependencies as one can get.
Yes. Like, let's say no third-party collateral that are held by another party that is in another place that might, have another dependency with a bank and so on and so forth, right? No.
Yeah, we are entirely crypto inside. Crypto
native
economy based. Yeah.
Yeah.
I don't want to say crypto native because I think it sounds a bit cringe, but we are as close as you can get to a system that just involves crypto and nothing inside the fiat. We really see kind of DeFi and the crypto economy as an emerging economy. And coming back to what I said earlier about these reference rates, if we're able to kind of define what it costs to borrow inside of this DeFi, this crypto economy, we think that adds a ton of value and makes it a much more secure place, which opens the doors for much bigger sums of money to come in because they can understand it in a mental model, in a pricing model with what they're familiar with. In the same way that an investor that says, hey, I'm not familiar with investing in, pick a country, Turkey or Japan, I need to go and I need to understand some economics about this. How much does it cost to borrow money here? How much can I earn if I save it? What's a 10-year rate? That's what we're trying to get to, so that people that are familiar with that form of thinking say, oh, I can deploy money into this because I know I can get 6% on this in a dollar-based asset, and I'm pretty sure it's going to be there tomorrow.
Yeah, absolutely. I think immutability is definitely a big part. And also, if I remember correctly, also Bold is not freezable, right?
We have no ability to stop Bold. That's good and bad. It meant we need to spend a lot of money and a lot of time doing security research, security audits. But now you have as much power over the system as we do. And as does anybody listening to this, or anybody else that joins the Ethereum network in 3 weeks. We are strongly aligned that DeFi should be immutable and it should be controllable by no one except for the Ethereum network. And we're really excited, and we spent a lot of time trying to build a system that would work with that in mind.
I love that. Okay, let's talk now a little bit about liquidation, right? That it's very different from redemption, by the way. So the two concepts are very, very different, one from one each other. So let's talk a little bit about how liquidation works in your system.
Yep. So our system, we like the liquidation system that we had in V1. We kept the same one, essentially. There are some small caveats inside of it because we now have a multi-collateral system. We work with 2 LSTs plus Ether versus our V1 only worked with Ether. What happens is if I hold Bold, I can deposit that into the stability pool, and the stability pool is where 75% of these borrowing fees go to. So that's how I'm earning money. Now, by sitting in there, I am taking a risk, and that risk is if there is a liquidation, somebody goes in and they identify a trove that or position that can be liquidated. It's below its threshold, or it's above its LTV if you prefer that way. And it takes that position and it closes it off, and it swoops out some Bold and hands collateral into the stability pool. What that means is if I'm a depositor in the stability pool, I now have given up some of my stablecoin, and I now have Ether or an LST at a premium price. So for every dollar Bold that I swap, I now have $1.05 worth of Ether or an LST. So it's advantageous to me. And generally, though not every single time, this will happen in a market where prices kind of crash and they're a forced seller in liquidation. In markets, we talk about forced sellers. These are people that sell at a not advantageous price. This is kind of, if you look at a chart when it goes like that and then comes back up, we generally tend to catch them more on the bottom. That means sometimes, and historically what we've seen, that 105, a couple minutes, a couple hours later, might be 110, 115, as prices hopefully start to normalize. So that liquidation is very interesting because we don't need to go out in the market. We don't need to have an active auction. We don't need other people to be there, provided that we have enough deposit in those stability pools. And as I said, we're passing as much as we can in there. So in general, we would expect those stability pools. And I think right now, roughly 1/3 of all Bold is in our stability pools. As you heard in there, I mentioned plural stability pools. This is where we kind of separate ourselves from some other protocols and even some forks of our V1. Mm-hmm. We allow a user to decide which collateral assets they want to open themselves to liquidations to. Mm-hmm. And by doing so, indirectly, that helps set those rates inside of those markets. So let's say that I'm a user that says, for whatever reason, I don't like collateral X. Let's say it's ETH, because nobody does it, but I really like LSTs. So we have Lido and we have Rocket Pool. So I'm going to take my Bold and I'm going to split it across those 2 pools. I don't want the regular ETH ones. That means that me as a user, worst case scenario, I only face getting changed into those on those 2 particular assets and never into ETH. This system is a bit different from everything else. We have a second round, which is if we exhaust everything in the stability pool and nobody wants to kind of add stuff into the stability pool in a very quick manner to catch those additional fees. We also have what's called now I'm blanking on the name. We have the ability.
Just-in-time liquidation.
No, even one step after that. So that's the just-in-time liquidation. Is we've exhausted our stability pool. Somebody puts money in to kind of facilitate further ones. We also have the ability to reallocate debt to other existing borrowers in a way that is not going to put the system at risk. So that means that I, as a borrower, might end up with more debt and more collateral to kind of offset against that in a way that preserves the safety of the system. And this is kind of a third line, you can think of it, as protection against liquidations.
Okay, and the penalty, I think, when there is a stability pool, is like 5%. So we're discussing about $1, 1.05, right?
Yeah.
Okay, is there any specific situation where the penalty might be higher?
Nope. The penalty will be 5%.
Okay.
Yeah.
Okay, cool. I think another important part is a very high LTV. Do you want to spend a couple of words about it?
Sure. Yeah. So there's a couple of things that mean that we let's first break the market in two parts. So there are protocols that allow me to borrow very liquid tokens, i.e., Tether and USDC. Because I can borrow those, a lot of those protocols tend to have, not always, but can have much higher LTVs than comparable CDP protocols like ourselves. So collateralized debt position protocols where you put an asset in and you borrow a novel token. Those tend to, on average, like ourselves, be lower. We're able to achieve a very high LTV. Our max LTV is just under 91%. It's 90.9111, or collateralization rate, it's 110. So we're able to achieve that because we have such a high pass through and because we have the stability pool. Other protocols that are based on CDPs, if you take Maker as an example, their LTVs will be closer to about 70 to 80%. Whereas we're able to go significantly higher than that as a CDP protocol. We don't see lots of users who are really kind of pushing that. There are some that are trying to get very high, but that does give users a bit more safety and a bit more time to react. We do compete, although we are generally, on average, lower than somebody that has USDC or Tether because those are just such liquid assets that we're pretty sure that we can always go out to an auction and sell $1 worth of Tether for pretty close to $1. Something like Maker, even with its advancements and being able to swap DAI or USDS now against USDC, they are not able to kind of get up to that level because they still rely on an auction. And we have seen a couple of times in the past where they've really hit the limits of that. So this is something that our users do appreciate in V1. Our LSTs are slightly lower because there are additional risks, but the max ratio is still about 83.33%.
Yeah. Yes. Okay. Fantastic. I think that we have been discussing a little bit on the mechanism design of Liquity V2, and I would like now to move a little bit in another area, and starting with asking to you, what do you think are the main personas or the main use cases for Liquity? Well, the two things are connected.
Yeah. So one of the things about having a CDP protocol is you have multiple different kind of sets of stakeholders who can be very different. So our kind of three big use cases, and then fourth I'll add in there after that, is leverage is very clear. People that want to put Ether or their LSTs in, and they want to be able to take equity out of that to borrow against it. So that's the first set of users. The second, very related, is a leverage. So somebody that puts in a collateral asset, uses our stablecoin to do a looping mechanism, and now has multiplied the size of their position because they think Ether is going to go up. That's a different, they rely on similar things. There's a third set, which are people that want to hold a stablecoin. They want to earn on that stablecoin, and that's a set of users. And then the fourth that I'll throw in there is, obviously we have a token called LQTY, and that kind of has its own community. Now there is an overlap between all four of these, but if I kind of spread it across, our borrowers tend to be our largest users. So there are three different sets of those users from borrowing, trying to put collateral assets in. The first, no surprise, given that we are very immutability focused and we're trying to kind of live with Ethereum ethos, we have a lot of Ethereum emojis. People that say this is the way that DeFi should be, and we are one of the closer ones to it. So people that really believe in DeFi and they really believe that DeFi should be immutable, we've tend to had a lot of success both with V1 and now with V2. We're hearing lots of positive thoughts and people coming into that. So that's kind of the first one. The second one, I would say, is a very interesting one that you would be very surprised with kind of coming next to that. We tend to have very large users that use our V1 and are now investigating coming in as we're starting to show up. And these are some of the biggest borrowers in the space. They are big trading houses inside of crypto, and they need leverage. They have lots of ether sitting on a balance sheet, and they say, hey, I need to go out and I need to get dollars because I want to go do other activities, but I think ether is going to go up, or maybe I have a hedge position that I'm using this ether as a collateral in a real world external thing. And the reason that they like us is because we're immutable. They know that they can become comfortable with our code. They can do internal audits. They can read our audits. And they know that we can't just wake up one morning and change something and say, we want to modify this parameter, and they get blown out and they need to monitor for that. So there's a lot of comfort when they can get over the technical hurdles. They realize what is a risk for them, and they can build their operations around that. And there's nothing that changes that. They really, really like us for that. And these are huge houses that are putting multiple $1 million positions inside of this. So really exciting to see kind of that take shape. We hope to see a lot more of that. And then I would say that there's a third party, which are some people like to just try new things wherever they fit into it. They're smaller on average. I would say these positions are a few $1,000s because we're on mainnet. I'm not going to sell you that we answer the little guy. I will come back to that in a bit about how we address that. But our minimum borrowing size is $2,000, which when you kind of do the math means the minimum size you can open a Trove with is practically probably 1 ether. So when you factor in gas fees and everything, it's probably not super economical, that smaller thing outside of a test, but a $10,000 to $20,000 position, that type of size, which is not the biggest Ethereum thing, but not the smallest either. So somewhere in that middle. And these people like to try new things, and they want to be able to borrow. They want to go out and do trade and arbitrage and that kind of stuff. And it's a good option for them. That's what we're starting to see. Leverage very much hits into the Ethereum OG community. It also hits into kind of that third one I brought up. The big houses tend to do it themselves. We have been used for that, but I'd say it's less. With leverage, kind of the interesting thing that comes in is people that can't get access to leverage elsewhere. So I'm not able, let's say I'm in a geography where I can't use Binance, or I can't use Kraken's Pro features or Coinbase's features. What do? I need to turn to DeFi. And we've seen a lot of our users. In V1, this represented about 1/3 of our positions were leverage users. And a lot of those users liked us because they said, you give me one of the few options that is cost effective to get leverage. We're having lots of new competitors, whether it remain that important for us in the future, now that we see things like Hyperliquid kind of really taking off, whether they don't find those more efficient than us. But there's a lot of people that still like the comfort of a CDP, still like the simplicity of the product, that don't have centralized options. So that's a really interesting use case for us, and a segment that I'm fascinated with. Stablecoins are a completely different thing. So I know this is a long-winded answer to you. Stablecoins tend to be much broader. We talk to protocols that say, I have dollars, I am a DAO, or I am somehow worried about what would happen if USDC or Tether froze my assets. I need something where that can't happen, and I need this money to be there in 10 years, in 20 years. I'm pretty sure that I can always reach in and get your redemption, no matter what. And even what they've seen with our V1, that is the case. Even though we have focused now on V2 as well as V1, we have seen users ask that and said, is there any risk here of my LUSD from V1? And the answer is frankly no. You can always redeem. You can always get the collateral in there. The same is true with our V2, and this is something that user group really likes. We also have just plain yield seekers, people trying to do trading strategies, things like that. But I think that's a really interesting use case of, I need something worth $1. I want it to always be worth $1. Maybe I'll get some yield on it. And if I go into a coma and wake up in 10 years, it will still be there. If somebody tries to debank me, it will still be there. That's a really, really cool use case. And that's something that really firmly fits into where we want to be and what kind of user we want to serve. And then the last one, as I alluded to, obviously we have LQTY token holders who are bringing in a governance aspect inside of what we're doing. this is very new for us. We're going to see, as I said, what are the results of how LQTY voters react. And this is the first time they've ever voted on anything on chain. Right. Previously in V1, it didn't have any governance ability. It was purely economical. Now we get to see what happens. We get to see what they decide and how they manage the protocol. And we're really excited to see how people make decisions around liquidity, how that helps the protocol grow, and how that can adapt over time to add in new venues, new AMMs, and other things like that. So I would say they have a much more central role in what we're doing, even if it is constrained to a quarter of the revenue of the protocol, which is not nothing. It's still a pretty important part. So we think this is really exciting. And we look forward to kind of growing the participation of the community that's holding LQTY in ensuring the success of the protocol.
Okay, that was an incredible overview. Regarding the QTY, I have a question. So they, for my understanding, just want to confirm, so the holders will still get basically all the benefit of Liquidity V1, right?
Yes.
Plus, they also can vote to allocate 25% of the revenue, if I remember correctly, but just for liquidity reason, essentially making sure that Bold have enough liquidity, for example, in Curve Finance, as you were saying before. Is that right?
So absolutely, let's split that part in half.
Yeah.
We built the protocol in a way where all the LQTY is passed back into V1 staking mechanism. So yes, any benefits from the ongoing function of V1, you still accrue. So you don't have to make a choice between, do I want to support V1 and do I want to support V2? By supporting V2, you're also supporting V1. So you don't lose anything economically from V1. We think that's really important for our users. It doesn't cost, other than setting up and paying the gas, they don't lose out. So if V1 continues to be successful, which we hope it does, they share in that benefit. Now, on top of that, as you say, it's voting rights. What can I do with them? 25% of the revenue, bundled up every single week, is split out according to the votes of the users. We have the ability to just set it and forget it, so I don't need to update it every single time. If you're familiar with something like Velodrum or Curve, you need to re-vote regularly. Our system, we've designed in a way where you can just vote once and then not touch it. Users like that because we're on mainnet. And if I don't want to make any choices, I don't want to reconfirm it and pay gas for that. What can you do with it? So far, we are running with kind of the preset things we put in there, which is Curve and the DeFi collective. Users have decided how that's split. They've asked and we put in kind of what our initial thinking was. But users ultimately decide. We can add in new things. Anybody, permissionlessly can add in what we call initiatives, new places where money can be sent, and this can be any Ethereum address. So DeFi Collective runs a multi-sig, and they move that money up to an L2, to multiple L2s, sorry, and they use that to incentivize inside of places like Aerodrome and Velodrome, Ramses, other types of dexes, as well as inside of mainnet, and they're also doing some POL type things. So there's no way that could all be done currently with the state of Ethereum from an immutable smart contract. And so they made the decision to do it through a multi-sig. Obviously, users have to trust that. So this is what they're voting on. Do they trust that or not? There have been some users that have voted against that particular thing. They've also decided to split between Curve, whether it's Bold USDC or Bold LUSD. In time, we hope to support a lot more DEXs. We've been having lots of conversations with a number of other DEXs that have similar gauge functionality to Curve. We're really excited as well about the development of Uniswap V4, which is kind of the news this week, obviously. And we hope to support hooks on that. And in time, what we're really, really excited about in that, as well as in some other protocols like Balancer, those hooks can be used to pass some of the revenue from swapping, what LPs currently get, back into the system in the form of a bribe. That means that I, as an LQTY holder, might have an equation in there where I say, hey, I'm going to vote for this one because I can get paid a little bit. So right now, it's does somebody like Curve, and currently there's something out there for Curve where users of the Curve system are voting whether to attach that inside their DAO to pay out CRV rewards to LPs, which is great. And users kind of can direct across that. But there might be an additional incentive that's not just co-incentives that brings some of that value back in to an LQTY voter. And the hope is that across all these, users say, hey, I can balance out ways that money can have a multiplier through additional stimulations like CRV or another comparable platform. And I can look across this and I say there's 3 stability pools that are swapping back 20% of the swapping revenue to me for voting for them. If I vote more for them, they get more bold as a percentage out of this each week, and I can pocket some of that additional swap money. It's designed correctly. That means that additional swap money that's passed back will go to the highest volume pairs because those are based on usage. So we're really excited about that and to see that develop. I would say that's still, a couple of months out, but that's something that has been designed into the system. If you go through the smart contracts inside of our V2 Gov, you can read them. There's no secret about it, and we do hope that that develops over time.
This is very cool. It's super cool. So you will basically have the possibility to monetize your voting power, and potentially, and hopefully, and this voting power also increase over time. So there is no locking period. But the more you are in, the more is your voting power. Is that correct?
Yeah, yeah. So it's we called it internally a soft lock. Obviously, I can come out whenever I want. So if I, as a user, want to stake today, and then in 3 months, for whatever reason, I want to come out of the system, nobody will stop you. You can decide whenever you want to do it, at the moment you want to do it. No cool off period, nothing like that. You just pull it out.
Yeah.
You do get more voting power the longer you've been in there. So this hopefully incentivizes users now who don't have these bribing, they don't have additional incentives coming back to come in and say, hey, I support this system. I'm signaling my support for the system, and I will have more power than somebody later on. This also is an important safety consideration that it reduces the ability for somebody to come in at the last minute and massively sway the votes. That's super important for us, and that was part of the key reasons to do this. He said people that are in this from the beginning for a long time should have relatively higher voting power, and people that try to come in and influence the vote in the last minute will have relatively lower chances of success.
That makes a lot of sense. We have seen a lot of, sort of governance attack, in the past. So it's good to have a mitigation system in place.
And I think a lot of that is just, we've learned a lot about governance collectively across DeFi, not just us, Liquity. There's a lot of things to be said about a VE system. It is a great system for a lot of things. The thing that we spoke with our users about is we're not emitting a bunch of LQTY token. We're 97-ish% emitted. We can't create more. It's immutable.
Yep.
So people don't need to be locked in because we're to figure out who to emit those to. So we needed a different system, and that's kind of how we arrived at this system. So we're really excited to see that we've already had roughly 70% of our users move from V1 to V2, which for us, from a staking point of view, which for us signals that people do like it. We'll see if we can hopefully get up to 98 to 100% transitioned over, and hopefully brand new LQTY stakers that never used V1. I don't have the stats on that one yet, but working on it.
Nice.
I know there's some anecdotally.
Very nice. Cool. Okay, so now, because you are in immutable protocol, so it is, in my opinion, one of the perfect building block in DeFi, right? Because you know that these guys are not going to change tomorrow, right? And break everything connected to it.
Yeah.
So what are the most important, what would you like to see, built on top of liquidity? What are the most important and interesting integration that you foresee in the future?
So let's go back to where I started this conversation. My background is on a trading floor. I work for French banks. French banks are known for complex derivatives. I worked in complex derivatives. I love that stuff. And I think that personally, and then I'll talk kind of wider, personally, I think that there is a huge opportunity for DeFi to build equally immutable or similarly immutable trustless governances or lightly governed products that appeal to mass market buyers who want different risk protocols. It's a lot of words. What I mean is I want something that people plug into our protocol and into other protocols as a building block and say, I can go out and I can sell to somebody something that I say, this will, after a certain amount of time, let's say 1 year, 5 years, will never be worth less than $1 for every dollar you put into it, or 80 cents, some kind of protection. And if the price of Ether or Bitcoin go up, you will make money. That's a type of product that people can look at and they go, wow, I'm worried about crypto going down. If you tell me I can never lose more than 20% after a 3 to 5 year horizon, and I can make almost as much or 100% of what happens when it goes up, that's a product that I can trust. This opens up huge markets of new people that want to come in. People that want to look at a risk-principled way of building very complex products that have lots of considerations that go inside of it, that need to live for a long time, that need liquidity for a long time, so that people can take this complex product and sell it in a way that is very simple for the user to understand, which is, I put in $1 today, in 5 years' time, I get the upside of Ether or Bitcoin, and if it goes down, I get $1 back. that's a trade that I really like. And that's a trade that a lot of users of traditional TradFi products really, really like. And I think that that's something with crypto and its historical prices and our hopes for something like Ether or Bitcoin in the future that is very aligned with where we want to be. Being able to bring that and deliver that in a decentralized product that's accessible globally for the first time, because these structured products and things that we do in TradFi are each country dependent, or within the EU, they can be transported across countries, but they're very set to a particular jurisdiction. I can't build the same product for a user in New York or a user in Johannesburg or a user in Tokyo. I need to build different ones for each one of those markets. With DeFi, we're able to build one product and then wrap it in a specific jurisdictional thing and resell that product. It makes it extremely scalable and brings the distribution mechanism down to a very light, reduced need for anybody trying to sell this product to somebody that wants to be able to buy it. I'm extremely excited about that. That is a huge market. Literally, we're talking about multi-billion-dollar markets on just bringing new money in and getting some of this upside potential. This is way more bullish for me than something like Ethereum having its own Michael Saylor. It's great if we can do that. This is lots of users coming in and saying, I want to share in the success of something like Ether or Bitcoin, and I want to do it in an ethos that matches what we care about in DeFi. You can break this thing down into kind of some of the other things, which is, can I build term swaps? Can I get somebody to run this delegation to say, I'll manage your borrowing for 3 to 6 months. You pay me a fixed fee today, and I'll manage this for you so you don't get redeemed. And if you get redeemed, I owe you money. I'll pay this back and set it back up for you. Being able to do things like that unlocks many new markets that we currently don't have, which we think can expand the size that DeFi can grow to. What this is, for us, is really about, with crypto, I don't want to say DeFi 1.0, 2.0, because people came up with that and didn't do it. But the first big movement, the breakout we had in 2020, was really about swapping. We had all of these new things. People who are around remember things like Sushi Swap and being able to add in benefits through liquidity mining and things like that. But it really kind of came back to this. I have this crypto and I changed it to this type of crypto. And Uniswap is the biggest, or one of the biggest DeFi use cases for that. The other biggest one, obviously now, are things like Maker and Aave, which is, can I put this thing in and I kind of save along the way, or I borrow along the way? Being able to go a bit further out in the future and being able to predict at a 3-month to 6-month time horizon means that we can get pretty close to what the US government does, or what European governments do, which is, for big companies, they manage their money up to 12 months at a time. If we're able to deliver 3 to 6 months, we are leapfrogging and we're opening up new markets for new money to come in with more certainty. We want to kind of allow users to be able to experiment with our protocol in a way to be able to build those things. Hopefully in time, that allows us to open up markets with 12-month time horizons. Those markets are trillions of dollars in TradFi. If we can bring even 5% of that into crypto out of other additional markets and people being able to save, and we can expand that because we're able to access these dollar markets globally in a way that TradFi cannot do in a cost-efficient manner. This is literally the next cycle and the next boom in the way that DeFi can grow. We're strong believers in that. We think this is beneficial, not just for us, but for all of DeFi. And we tried to design our protocol, as you said, immutably, so that others can benefit and they don't owe us anything.
And super exciting, super exciting. We just need to make Ethereum a little bit more DeFi focused as we started, and that's all about it, right? That's
They're getting there. They're getting there. I know that's been a big hot topic of conversation. Everybody has views on that. We were very excited. I do have to shout out to the Ethereum Foundation. We were very excited that when they retweeted our launch announcement, it's a small thing. The team was very excited to be able to say, oh, great, we got noticed by the Ethereum Foundation. So if anybody from the Ethereum Foundation is listening, thank you. That's awesome. So love to see that. Would love to see all the big protocols and small protocols that are doing innovation inside Ethereum get more recognition from places like the Ethereum Foundation.
Absolutely. In particular, in my opinion, DeFi, right? Because it was for a very long time out of the radar, where it should be, in my opinion, at the core of our spiritual life in the Ethereum, right? That would be my thing. But
look, I am heavily biased towards DeFi. I'm also excited by a lot of other use cases. So I want to see DeFi take what is its rightful place inside of the Ethereum ecosystem.
Yeah.
Just as I want to remain open to anything that's not DeFi just taking off in Ethereum, and I would love to see it all.
Of course.
And I use Ethereum in the widest possible way, which is, to me, anything that uses an EVM. So,
Yeah. Yeah. I think you briefly touched to another topic when we were
yep.
discussing about possible, building blocks so in this fantastic DeFi Lego. And one of them was your almost like the possibility to productify, or basically using the interest rate because you will have ideally thousands of millions of data points of people setting their interest rate with a different size. Potentially, you have information about what people or what those people hold and so on and so forth, right? Because they have a public address. And I think you mentioned briefly that also these can be something that you can use in the future or other products can use in the future. Maybe you want to elaborate a little bit on that.
Yeah, so I mean, there's a couple of things that are really cool. I would highly encourage people to come check out our Dune dashboards. All of our links are in our docs at liquity.org. But you can kind of see what happens, how people are borrowing, where they're setting their interest rate, how much they're borrowing, how much collateral they have. We have this cool little bubble plot that shows that. I know the guys at Parsec created one that we kind of modeled ours off of. Really cool to be able to see that. And that, if I'm trying to build another protocol and I want to target users with that public stuff there, being able to tap into that and saying, hey, I want to target a product that specifically is only accessible to people that are paying at least this much or have at least this much in there. The data's on chain. We can open up things. I mean, I spent some time with NFTs. One of the cool things we did with NFTs is we allow people to mint based off of on-chain data. It's very rudimentary in 21 and 22, but that's something that's kind of cool. So if I'm able to allow people to come into my protocol on-chain trustlessly based off some parameters they've set and how they're borrowing without needing to rely on indexing stuff on off-chain, I think that opens up a lot of doors. I know that's a bit high level at this point, but we're starting to see interest in people to say, hey, I can segment and I can pull out information that open up the ability to do different things based off of what's happening on chain. And you guys can't stop me from doing that. And that means potentially they could take our users. But that's something that hopefully adds a lot of value to everyone involved because users get a better outcome for building and using the protocol in the right way. And all that information is available to anybody else that wants to build on top of us or wants to compete with with the protocol we've released.
Yeah, and touching to that, you were touching also on possible people, taking something from you or using something for you. But what we have seen we have seen a bunch of other protocols as a friendly forks, right?
Mm-hmm.
I think already 15 or something. That's already incredible. That's
Yeah, we have some others in the pipeline, and since we launched, we've heard from a few more. We hopefully will continue that. So because we're on chain, we're inside of mainnet. We have a very select set of collaterals. It's immutable. We can't upgrade. We can't change what's out there. But obviously, that opens the door to what if I want to do this inside of an L2 or an alt L1? I need to have an interest rate that's accessible on chain. I want borrowing that's accessible on chain. We didn't see a lot of that happen outside of Liquity V1. That was kind of a renaissance moment for borrowing directly out of the CDP in other L2s. There were some things that we learned about that and why those, in our opinion, didn't take off outside of very ephemeral things. There were some that were quite large, but none of them really lasted as long as our V1 has. Our hope is we have done things in a way which is a bit controversial. We used a business source license for our code base for the core part of it. Our governance is in a different open source license for the first 3 years. This is the same thing as Uniswap has done with V3, V4. Morpho has a similar thing. Arbitrum also has this for their code base. We're not the first ones to do it, but we used it in a slightly different way, which is we said, we're going to concentrate on this niche of a very conservative set of collateral in mainnet. We realize there's a huge market that we're giving up by not going into places like Arbitrum, Avalanche, Scroll, which just went live yesterday. But we also can't manage this as a team. There are people that can do this in a much better way, that can access their ecosystems, that can build relationships with those foundations. And previously, I worked on a protocol where we tried to offer things across a lot of different networks. And what always fell down for us is we could not scale our ability to work effectively with those communities and the user bases, which are very diverse. What's really interesting and was kind of a light bulb moment for us was a user that uses Arbitrum to do DeFi often looks very different than the one that uses Base, which often looks very different from the one that uses Avalanche. they need very different things, and they need teams that want to work in a native way with those particular communities. And so with our friendly fork approach, the idea was, let's give the tools to teams that are very good at doing this. Let's do it in the lightest way possible, in the most conducive way possible for them. In return, most of these teams have given our users, not us, about 4% of their tokens or other revenue that they put out back into our V2 ecosystem, which we're very excited about. And you'll hear more and more details. Scroll just started to share some of theirs with Quill yesterday. You'll hear lots more about this in the coming days and weeks. Mm-hmm. This is passing that value back. And we talked earlier about where does it come? How do we bootstrap? A lot of it's this, and will grow in importance and in visibility. We're super excited about that. The other reason we're very excited, not only kind of fitting in those, they can adapt to different collateral types. They can spin up new things, do them in a slightly different way that fits into their community, and grow this out. And I really look at a metric that's not only how much TVL or Bold do we have minted, but it's how much will be inside these forks. And for me, that is the success of what we built as a code base and proves the ability and adaptability for this. The other side benefit of doing it this way is, to an extent, it gives those teams much more certainty that they don't have a lot of competition of people that are doing the same thing as them and just juicing in a higher token emission to try to kind of Ponzify the game. We strongly believe that they should build the best outcome from users, which are what we talked about earlier, that kind of 4 sets of users, and building the products in ways that users want that will remain there. And our hope is these will be very secure protocols on the same footing as us. We'll have very good economics on the same footing as us that deliver value to the users in the best possible way for their communities in a way that is built directly for them on top of a code base that we're thoroughly have looked into.
That's super exciting. I love, first of all, the focus, and I love also that you're staying with your users, with your community, people that you know, right, on mainnet, but you also give the possibility to others to experiment and cover other, L2, for example. And there will be also potentially airdrop, I believe, to people. Who knows? Maybe people using the stability pool. Maybe, I don't know, LQTI use. Who knows? Everything can happen.
Check the announcements. All of this, there are great things coming out. I'm super excited. I think that paying attention to these ones, especially if they're communities and other networks that you are using or care about, being involved with those, there's no downside in doing research.
Absolutely. There are only upside in that regard. Amazing.
You read that however you want.
All right. So before we go to the end, what are the next step or the milestone that are most excited about in the future of Liquity V2?
So, I mean, one of them was this conversation we just had. I want to see all 15 of those forks go live, and I want to see people appreciate them and see the teams we've been working with. We have kind of a Telegram chat with the other teams where they've been sharing kind of technical input or ways they're thinking about things. And it's amazing to see kind of the diversity in there of how people approach it. It's amazing to see what people are doing and pushing the envelope and sharing what they're doing there. So to me, that's already a massive success inside of that product. And I want to see them all go live, and I want to see them be successful. I would love to see one of these forks have even more TVL than us. I hope our TVL continues on the path that it's been on, which has been very positive. But I think it would be a huge success if one of the forks in an L2 or an Alt L1 has even more users than we do, because they're able to tap into those. So those are kind of some of the things in there. As I alluded to, we want to see this protocol become as large as the market needs it to be. We're not trying to create weird incentives where this thing should grow to some crazy proportion because people are trying to chase some yield or doing something here that is based off of non-realizable numbers. We want this protocol to grow in a healthy, sustainable way for the people that want to use it. I work in products, so I'm very biased, but we want people to use the product, and the metrics that we care about as a team are that people are happy to use it, not just that it runs and runs and runs and gets people spinning up to try to claim rewards that they then sell in the market and everybody else gets washed out. We've seen that happen time and time again, and our hope is, with this DeFi renaissance that people have been talking about, that people realize that there is a lot of money that goes into it and a lot of value created. And when we share as much of that value as possible, that creates a better outcome for users. And that's really what we care about, is that our users in all of these buckets and all these products that we talked about earlier are able to get something from us that they can't find elsewhere in the market, served in a way that we can.
I love your philosophy and your ethos, to be honest. Very, very, very much aligned to, I think, the most true Ethereum cyberpunk ethos, and I love that. And you're also bringing real yield, right? That's what we are talking about. So it's not inflated, weird things, Ponzinomics, abstract things. Just they pay for us for borrowing bold. We just give them back in the stability pool. That's it, right?
Yep.
It's kind of transparent. Actually, super transparent.
It's super transparent. We can't do anything with it. So there's no hidden games. It's all visible. Goes in one side, comes out the other.
Absolutely. All right. Well, so before we close, is there something that you want to tell to builders out there if they want to, I don't know, maybe launch another Friendly Forks, and also people, how can they connect with you?
Yeah, so doors always open for Friendly Forks. There's a guy named Max on our team who's kind of the center point for that. You can find that details through liquity.org. Come to our Discord, mention it in there. Feel free to reach out if you know anybody on the team. Everything gets funneled back to him pretty quickly. You can get a hold of me. All my handles are Colin with one L, G Platt with two T's. Hopefully it's shared inside of here. Feel free to get a hold of me on, you pick, anywhere that you can find me. Would be very happy to chat with you about anything you're doing there. We really want to get more users, people that come in to try our product, hopefully love our product. We're happy to hear feedback. We're continuing to work and develop our UI kit, which are run by third parties, as I remind you. And we also have DeFi Saver, which has built that directly into their platform. Huge shout out to DeFi Saver. They've added on top of this, and we'd love to see more of that. We think it's a great product that they've built, and we're very, very happy that they decided to integrate us on day one. Really, really big fans. We know lots of our users have mentioned time and time out in V1 about things that DeFi Saver was able to do that we hadn't even thought about, being able to automate different processes. And we think that's, for a user, that's great that they're there, not only for us, but for wider DeFi. So big fans there. So I would definitely say, if you're thinking about using us, come check out liquity.org, check out the front ends that we built stock things for, check out DeFi Saver. Would love to hear your feedback, room that we can improve. We are doing what we can. We do have a pretty big log of things that we want to get into the next release. So would love to have more feedback on things that you like, things that work, things that don't work, and any other ideas you have around that. So liquity.org, so liquity.org is kind of your access point, and that'll drive you into all the channels, all the places you can look into. Would love to have you as a user.
Fantastic. We'll put all this link anyway also in connected to how we're going to distribute this content. And what can I say, Colin? It's been a fantastic pleasure to learn more about Liquity with you. It has been so insightful and so intriguing, to learn more. And well, I would love to invite you again, at some point. For now, we only can say to everyone, to all our users, well, use Liquity V2. And well, think about super cool stuff like a structured product to build on top of it.
Yeah, would love to hear from everybody. Would love to see you guys as users. Really appreciate coming and joining you today. Been a fun conversation.
Okay, so thanks a lot, and have a beautiful day, guys.